Okay, welcome. Welcome to Options Bootcamp 2023. My name is Dave Whitmore. I am pleased and honored to be opening the session here and to welcome you aboard for a series of 6 topics that start with the most basic definitions and things regarding options and builds up to what we think is going to be a good foundation for continuing to learn about the flexibility and breadth of things that you can do with options. Got a big crowd out there. Thank you all so much for showing up. I also have colleagues on the back end, the rest of our investor education team here. So I'm Dave Whitmore. I've got Steve Clausen, Sean Howell, and Rick Swope also here. If you have questions, you can type them in, and the guys in the back can respond. We'll see if we can do some verbal Q&A as well. So let me do a little bit of housekeeping before we get started. First is to bring up our disclosure slide. Look, the main lesson, there are 2 main messages I want to deliver here. One, we're not giving you advice. We are educating you on the things that you can do with options and option strategies. It's also true that options aren't necessarily for everyone. They're complex. They can be used in very risky strategies. They don't have to be, and that's going to be a big part of what we're going to try to impart today. The fact that there's an enormous toolkit and flexibility available to you, and we're going to start from the basics and build up from there. Below the screen, you'll see a number of colorful boxes. We have a survey, and I'm highlighting it right now. We would love your feedback. Along the way, at the end, either way, we certainly would appreciate that. You can also find copies of our slide decks in the resource list. There are other links there with material related to our topics. So with that, I want to start by asking you to reflect to us your confidence with options. And so I want to do it with a little poll. Let me pull this up, push this away. So my question is, how confident are you with option concepts? You may have some experience with it. You may have 0, and it's perfectly okay if you have 0. I'd be surprised if anybody said they were very confident. If you are very confident, then this will be a refresher because we are speaking at the let's get started point of view. So I'm we'll take a look at how these compare before and after, but I'll leave it up there for a little longer for you to I see some fun interaction there. Esther's response is fearful. On a scale of 1 to 10, a 4. All right, so that's some fun stuff. And again, I'll leave that there for a moment. And I guess part of asking that is for you to then see how you feel at the end, and we'll ask these similar questions as we move along. So let's get started. So we're going to go through this in a sequence here. First, we're going to talk about the very basics. What are they, and why do people use these things? Then we're going to get very definitional, some language and terms and relationships that may very well be new to you. And then we'll dig into the sort of the nitty-gritty. What is an option worth? And then I'm going to push you a little bit. The session, if you'll notice, is the longest of the full day because I'm going to push you a little bit. We're going to introduce ideas of probability and time and volatility, really important components of how options behave. And then we'll start talking about actually making an option trade, which is going to be the focus of the second session. I'll get you partway there here. We're not going to be ready to make the trade yet, and then Sean will come in. So that's topic number 2. Number 3, we're going to learn about covered call writing, which, interestingly, one of the questions that came in before we kicked off was a person saying, I have some Ford, I want to learn how to generate income from that. Well, that's a strategy of covered calls. And then my colleague Rick is going to do a session on puts, the power of the put. and then we'll end the day with some platform sessions. Sean will do a dive into options trading on Power E-Trade, and I will do the same for the website. All right, so that's our day. So let's get started. So why do people use options anyway? Why do they trade them? Well, the first reason, which is sort of probably the most intuitive, which is probably what you have in your mind, is this idea of speculating with options. It's sort of the history that people have of the perception of them, and that is because options give a trader leverage. Leverage means you get more of a return or a price move in an option than you would in, say, the stock. You get more bang for your buck, as it's said. Now, this is the sort of most basic, simplest way that many people think about options. But the beauty sort of is that there are also strategies that are sort of the opposite of that. So income strategies are not really speculating for leverage. They're entirely different. And there are also option strategies that can be used for protection, to hedge. So this is just sort of one look at sort of the motive that is behind options and option trading. Now, let's get into the what. And I'm going to suggest to you that if you can understand something very simple, like a pizza coupon, you can understand a call option. Follow me on this. Okay, so here we got a pizza coupon, right? This piece of paper in your hand says you could go to Luigi's Pizzeria with this coupon and $10, hand it over, and receive one extra large, one topping pizza. And you could do that anytime you wish until it expires on December 31st. Right? Makes sense, right? Easy. Now, before we move on to the idea of the option, I want you to think about what having this coupon means to you. So I'm going to introduce one of the first terms that is very important in options, and it's the idea of a right. So when you have this coupon, you have a right, a very specific right, a right to buy pizza, and that pizza is one extra large with one topping at a price of $10 at any time until it expires. Okay, got that, right? Makes sense. Understand, you don't have to buy pizza. You don't have to go to Luigi's. You don't have to like Luigi's. You would only use this coupon if you wanted that pizza and it made economic sense. What do I mean by that? Well, let me ask you this. What's the value of this coupon in your hand right now? Well, to answer that, you would have to know what the price of the pizza is, right? So if you knew that pizza was $12 at Luigi's, and you had a coupon that enabled you to buy it for $10, then I think we would agree that that coupon is worth $2. Makes sense, right? Okay, keep that in mind. Now I want you to think about Luigi. Luigi is the other side of your right. So he has an obligation to sell you that pizza if you present the coupon and the $10 and the pizza coupon has not expired. So he has an obligation, and I use this word obligation. I know it maybe seems odd in terms of a pizzeria, but this idea of a right and an obligation is inherent to how options work. Keep those in mind, because now we're going to continue to dig into the actual aspect of an option. So, as I said, if you understand how a pizza coupon works, then you can understand the basics of a call option. A call option, and by the way, notice the word here, contract. So in options, we don't trade shares, we trade contracts. So an option contract gives the owner of that contract the right to buy stock. The stock is specified, and it is 100 shares of stock, usually. Almost all options start out at 100 shares. There can be corporate situations that change that. Assume 100 shares. Talk about maybe as the day go on a little bit. So it's 100 shares of XYZ at a specific price that is part of the contract. It's called the exercise price. It's also called the strike price. and for a limited time. And that time is up until the expiration of the option. So that's a call option. The other option that a kind of or type of option is called a put option. We're going to be focusing on a call here primarily, entirely. And then in the second session, Sean is going to make a trade using a call. The call is I think, is much more intuitive because it represents the same way we think about stock, owning it and buying it. A put option is the right to sell stock. So the put owner has the right to sell shares of stock, and it's specified in the same way, 100 shares of the stock symbol at the exercise or strike price up until expiration. Now, a put option doesn't operate like a coupon. And I'll just give you this analogy. A put option, it's easier to understand it more if you think about the way an insurance policy works. If you have auto insurance on your car and there is an accident, the payment you get from the insurance company makes up for the loss you have in the car. A put option will rise in value as the price of the stock falls, so it moves against the value of the stock. We'll leave that behind. My buddy Rick is going to come back and talk about puts in much greater detail later on. Let's focus on our pizza coupon. So now we need to sort of define some important terms. And I want to start off with this idea that unlike a pizza coupon, you have to buy an option. Options trade, trouble here? Looks like you can see this. Options trade in a market. With the pizza coupon, you get it for free. You know, they put it on the box when they deliver it, or they hang it on your door, or they slide it under your door, whatever. Options aren't distributed that way. They are bought and sold on exchanges. And so here you can see just an example of a quote being displayed. In an old-fashioned way. I'm sort of depicting the Chicago Board Options Exchange, where these market makers are actually talking to each other. So there's a broker saying, what's the quote on these particular call options, and the market maker gives them the price. So that is where my initial analogy falls apart a little bit. But so with that in mind now, I want to go through the terms. I'm having a little slide problem. Let me move. All right. So here, now I'm going to introduce, we're going to go back to the terms of rights and obligations, calls and puts, and then I'm going to introduce this idea of long and short. So first we have this option that trades on this exchange. And someone who buys that option is said to own that option. The other side of that trade is someone who has sold the option. Every purchase of an option is being sold by someone. That option seller is said to be the option writer. So when you own an option, you're said to be long that option, and when you have written an option, you're said to be short that option. And here's where the market price comes in. Because when you buy an option, you pay what's called the premium, the price of the option. We're going to get to that. That is received by the seller of the option. It's not the exchange that gets that money. It's not E-Trade. You pay an option seller. So you are both part of this trade, and that transaction occurs at the market price of the option. These are traded on exchanges, and they're cleared and move from firm to firm through what's called the Options Clearing Corporation, the OCC. So when you buy this option, you have a right. We don't know what that right is yet because we're going to get to that with puts and calls. But when you buy an option, you have a right. Remember, like the pizza coupon. Wherever there's a right, there's an obligation on the other side of that trade. So the option writer has an obligation to fulfill if the option owner chooses to exercise their right. Exercising your right is like going to Luigi's and forking over the $10 in the pizza coupon and getting the pizza. That's exercising your right to buy pizza. And in that case, Luigi's may be assigned. So this is the idea that when you write an option, you may be forced to carry through on your obligation. And that's called being assigned when someone who owns the option exercises their right. Okay, so now we can talk about calls and puts. So calls give the owner the right to buy stock. The other side therefore has to be the opposite of a buy, and it has to be an obligation if one side is the right. So the writer of a call option, the seller of a call option, has an obligation to sell stock if the owner exercises his right to buy. And so if you own a call option, you're said to be bullish on that stock. And if you are short a call option, that is a bearish position. What about a put? The owner of a put has the right to sell stock. Notice that is not the same as the other side of the call. The other side of the call is the obligation to sell. The right to sell and the obligation to sell and the right to buy or the obligation to buy are not the same things, and don't think of them that way. Owning a put is bearish, and shorting a put is actually a bullish strategy. Okay, relationships and terms, but now let's talk about these actual option prices, because as I mentioned, you need to trade the option. You don't get it handed to you. So I looked at a stock, and I made it into a fake stock here. It's XYZ Corporation. It's about 47 and change, 47.86. And I looked at some option prices. So for instance, I noted that you could buy a call option that gives you the right to buy 100 shares of XYZ at a price of $47.50. And that's good for 72 more days until it expires. We'll get to that information coming up. And the price of that was $2.78. Now that's $2.78 per share in the contract, which is 100 shares. So that is $278. And there are other choices. So unlike the pizza coupon where the price is on there are coupons that let you get pizza for $8, let you get pizza for $10, let you get pizza for $12, and so on. And so we can find a number of other options on this particular XYZ stock. The right to buy the stock at 50 is cheaper than the right to buy the stock at 47.50. The right to buy the stock at 45 is more expensive than that. And then there are other strike prices or exercise prices that are much less expensive. So this is the kind of menu that you get presented with when you make a decision that you want to use an option to make a trade. So let's look at where these prices come from. It comes from what's called an option chain. So an option chain, again, a term that was invented decades ago and persists to this day. Certainly has some applicability in this sort of the way it's displayed. It's basically a table of prices and information. Now, I'm starting off with a very simplified view here. We're just looking at the bid and the ask and the last trade. We'll expand these columns as we move along. But navigating the chain, first is across the top where the available expirations are, and then down the center column where the available strikes are. And then on the left side, you'll see calls, and on the right side, you'll see puts. A couple of items here. Whether options are available on a stock or not are a decision of the option exchanges. It's not a decision of E-Trade to present options available or the particular company. It is the exchanges that make that decision. So and it is the exchanges that determine which expirations will be available and which strike prices will be available. Okay. So now let's look at one particular quote. So I'm zooming in on the 50 strike price, and that price there is $1.44 bid, offered at $1.52. And so remember, we use 100 multiplier. So if you were to buy that option at the market right now, the offer price or the ask is $1.52 or $152. Pretty simple, right? Now let's move deeper into that price. So an option price has two values that we want to pay attention to. One part of the option price is called its intrinsic value, and the other is called its extrinsic value. So let's break it down. The intrinsic value is a very straightforward number. It is simply the difference between the stock price and the strike price. So in the case of our example, this is just the difference between the pizza price and the coupon price. Remember earlier when I said, if pizza's $12, what is the coupon to buy it at $10 worth? And we agreed it was worth $2. Well, what if I told you that that coupon is good for 10 years? Well, maybe you'd say it's worth a little more than $2. Or what if you knew that we were in a very inflationary environment? You might say maybe it's worth a little more than $2. So what I just introduced, it refers to this idea of what we call extrinsic value, or simply time value. So the extrinsic value consists of how much time is there to expiration, very importantly, and also very importantly, how much volatility is present in this stock. And then prevailing interest rates and whether the stock pays a dividend or not are part of they're not important enough for us to discuss in any detail here. They are part of what makes up this additional part of the option price called its extrinsic value or time value. So it's very straightforward. So let's look at it in the option chain. So we'll focus in on certain areas. Notice this area here. I've added a column called intrinsic value. And you can see here in this sort of light purple shaded area, the intrinsic values are all positive. In fact, and we call this in the money. So notice the strike prices here, the $47.50, the $45, the $42.50. Those are all the right to buy the stock at a price lower than it is right now. So these are options where the coupon price is lower than the pizza price. On the other hand, for the lower part, where it is unshaded, you'll notice that the intrinsic value for all of those is zero, because they give us the right to buy the stock at something higher than we could buy it in the open market right now. For instance, the first one we were looking at there is the 50 strike, which has $1.50 or so. But we could buy the stock in the open market at $47.98 right now. So the intrinsic value of that option is zero, but it has a market price, right? So that's where time value comes in. So let's focus in on these particular strikes. So first off, the extrinsic value column is right next to it, but it's just, again, the difference between the strike price and the current price of the stock. So the $42.50, the price of the option is $6.48. By the way, I'm just using the midpoint between the bid and the ask for that option price. Its intrinsic value, though, is $5.48. The 45, the option price is $4.45, but its intrinsic value is only $2.98, and so on. So we can do simple calculation that the rest of the value of the option is what we call the time value of the option. Okay, so a couple things about time value. One, notice that it is typically highest in the strike price that is closest to the current price of the stock. It's just sort of an interesting observation, and as you learn more and more about how option prices move and you start to think about putting them together in strategies, this relationship becomes an important component. So pay attention to that. The other thing I want to point out here is what we call the break-even point. So the break-even price, which is something that you should be mindful of, is the price at which the stock needs to get at expiration for your option to be worth what you paid for it when you bought it. To calculate that, it's simply the price of the option plus the strike price. So $42.50 plus $6.48 equals $48.98. So if the stock is at 48.98 at expiration, my option will be worth exactly what I paid. In other words, it needs to be higher than that at expiration for me to be profitable. Now, I caution you. I'm dwelling on this at expiration here because it's an easy way to illustrate the relationships. But what you're going to find as we discuss this further is that most people, especially those who buy options, don't hold them all the way to expiration. We'll continue to develop that as we talk throughout the day. But let's move on. Before though, let's recognize that the higher the strike price, even though the option is cheaper, it implies a higher break-even price that the stock has to get to for us to be profitable. Let's explore that at expiration idea because I think it nicely illustrates the way the leverage works. And it also shows you where the risk of loss is. So here's what my table shows. If I've taken those 5 options, you can see the first row, the 42.50 strike. The option premium is $648 for a cost of $648. If at expiration the stock is 45, meaning it fell a little bit. Remember, it was 47.98, 47.99. So the stock is down 6%, closes at 45. What's our option worth? Well, it's the right to buy the stock at 42.50. The stock is 45, so therefore it's worth $250. We paid $648, so we're down about $400. It's not a total loss. It has value. And if we look at it moving to higher prices, here's where we start to see the leverage come in. So if the stock gets to 50, our option's worth $750. We made a gain of $102. It's a 16% gain, modest for sure, but the stock only moved up 4%. So 4% move in the stock produced a 16% move in the option. And then if it gets to 55, we get an even sort of more turbocharged leverage on the trade. The option is then worth $1250. We paid $648 for it, so we're up over 90% on the trade. We made a $600 profit on a $648 commitment. Okay, so that's the first row. What about the second row? Well, take a look here. If we bought the 45 and the stock closes at 45, well, this is a situation where all of the value of this option has dissipated. There's no time left, and there's no intrinsic value. So therefore, the option expires worthless. And that lesson is then true at every strike price higher. All of those strike prices are 100% losses if the stock is only at 45. Okay, what if we traded the 45 calls? Well, if the stock gets to 50, our option then is worth $5. We make $55 profit for 12%. If it gets to 10, though, we make an even a better return, over 120% compared to the 93% on the lower strike. And then we can carry through the rest of the values, and I won't dwell on each particular number. You can just see that where there are a whole series of cells where you have a 100% loss because the option expires worthless. But if you are correct, the more you're correct, the more levered gearing you get on that trade, and that's where the big percentage returns on an option trade come from. Again, let me stress, especially option buyers, most do not hold contracts to expiration. They use the vehicle for a way to trade on the price movement in a stock temporarily, get on it, achieve the levered move, and move off of it. And there's a big reason for that, and that's because of the impact of time, which is something that we're going to continue to develop here. All right, so probability, time, and volatility. So one of the aspects with option analysis is that we introduce the notion of probability as an important part of our analysis. And so we have a column in Power E-Trade that is labeled the probability, let me read it literally, prob ITM EXP ATM IV. Okay, what a mouthful, right? It's a simple concept. It's the probability that that option will be in the money at expiration, and it's based upon using some volatility calculations. The basic idea is if a stock exhibits a lot of swing, meaning it's very volatile, then the chance that it reaches higher or lower prices is greater. It's not a prediction of one direction or the other. It's simply based upon how much swing is in that stock's volatility profile, okay? So let's take a look at it. So if it's telling us that it's the probability that the option will be in the money at expiration, my question to you is, okay, but what does that really mean? Okay, so consider this. I've got our same 5 options here, right? We've got 5 different strike prices, 5 different prices. Very high-priced option, giving us the right to buy pizza at a price much lower than pizza currently is, and a very inexpensive option that is the right to buy pizza at something higher than it is right now. It's the right to buy the stock at $52.50, and it's only about 48 or 49. Okay, so here are those probabilities. Okay, so the 42.50, which is already in the money by a good amount, like $5, has an 83% likelihood that it will be in the money at expiration. On the other hand, the right to buy the stock at $52.50, that lower strike price down there, has only a 23% chance of being in the money at expiration. All right, so consider this though. Does being in the money at expiration mean you're profitable? And the answer is no. We just learned that by seeing that you can be in the money, but the option value can be less than what you paid for it. So the right way to interpret this and to recognize what does being in the money mean, it means being above the strike price by 1 penny or more. So if it's just a few cents in the money, then the value of the option is very minimal. So the right way to think about this is that what it's really telling us is it's telling us the probability that the option will expire worthless. And so now we see the true lesson of that in-the-money option, as we call it. There's a very low chance of expiring worthless. So it is less risky than the rest of the options on our list. And so this underscores the other side of option prices. When we see a list of option prices, oftentimes we're attracted to the low-cost ones. Those have to be the out-of-the-money options. And the bottom line lesson is you're just taking on a higher risk of loss. But there's other ways to think about it, and we will continue to explore those through the rest of the day. So that's sort of this idea of probability. There's another way to think about probability. And so here I'm going to introduce one of these areas where I'm pushing us a little bit. The term is called delta. It's derived from an option pricing model. We don't need to go into that. We're going to talk about it in its most simple way right here. And it is simply a number that my animations aren't coming up, it seems. Delta expresses how much an option price is expected to move if the underlying stock moves by $1. So here's delta on our chain. You can see I've added it. Let's take a look at the specifics here. So I've focused in on the 50 strike. It shows a delta of 0.4132. So what that means is the option, which is currently $1.50 or so, $1.52, if the stock rose $1, we would expect this option to rise 41.3 cents, or it would go to the price of $1.93 from $1.52. If it fell $1, the option would be expected to fall to $1.11. So that's the literal interpretation of delta. If you're curious about it, you can go Google it. If you're super curious about it, you can go into etrade.com/events and go find a presentation that we have called Understanding the Greeks, where we go into it in much greater detail. Okay, so that's the strict definition. But delta is also used as an estimate. So in the same way, we think about it as probability. So here we would simply say that delta is saying that this option has a 41% chance of being in the money at expiration. That's a little bit different than the column next to it where the probability using the implied volatilities is 35%, but you'll find that these are directionally consistent. And let's not be too hung up on the precision of the numbers. It's broad directionally thinking is the way we should be looking at them right now. So we've introduced this idea of probability, and I want to sort of turn now to the other big component, and that's time. So remember I sort of teased you a little while ago, and I said, if you had the coupon, let's think about the pizza coupon again. So you're at Luigi's, or you're near Luigi's, and you see that the coupon has some intrinsic value, and that it's like expiring today. So it's either basically use it or lose it, right? So it's worth precisely the $2 that we were imagining. But if you look down and you said, wow, it's good for 10 years, you would, in your mind, ascribe a little more value to it than the simple intrinsic value. So that's where time value comes in here. Now let's talk about it. I'm having a little trouble forwarding my slides. I don't know if the guys in the background are seeing anything, but I am.
Yeah, I think you're okay so far, Dave.
I want to be on the slide that says it's time on your side.
You're not there yet. Now you're on. Now you're there. Yeah.
All right.
Now you're there.
All right. So here's where I'm introducing another of these so-called Greeks. And again, we're not going to get into the derivation of it. I just want to sort of illustrate for you what time does to an option. The measure is called theta. And I really sort of don't want to dwell on it anymore, other than to sort of show you the interpretation of it. So here on this particular option, the theta is 0.0145, very small number, right? So it basically says if the option today is worth $1.52, well, tomorrow, same time, same bat time, same bat channel tomorrow, the option's going to be worth $1.50, just because a day less in its life is available. That's called time decay, and it's an important component of options. And so let me illustrate time decay for you a little bit here. So here's what I did. These are theoretical values for a call option, but what I did was use an option tool that we have in the website that allows me to calculate a theoretical option price by giving the platform the price of the stock, the exercise price of the option, the time to expiration, how much volatility is in that stock, and what are prevailing interest rates. So those are all inputs, and what I get output is a theoretical option value. Okay, so now I've charted it. So what we're showing here is that if there are 125 days to go to expiration on this $50 stock with a $50 strike, so I'm calculating it right at the money strike price, the theoretical value of that option was $4.25. If I do the same calculation, all the same data point, but I use 115 days instead of 125 days, well, the option's theoretical value is only $4.05, or 4% lower, because there are 10 days fewer. Okay? If you take a look, if you look at this chart, you can see a little bit that it's curved. So as we move to subsequent 10-day periods, so for instance, here I did a calculation with 95 days to go. It was a little over $350. And then a calculation with only $85, and it was $350. So 6% lower. 8% lower in this 10-day period, 16% lower in this 10-day period, and 42% lower during these last 2 or 3 weeks of an option's life. So this is a very powerful factor in how we think about options, this acceleration of time decay. The very idea that the pull down on an option's value becomes so much stronger in each day as we get nearer and nearer to expiration. And this is part of the reason why, what I explained to you earlier, most people who buy options to speculate trade out of them before that extreme time decay period starts. And that's usually sort of at the 30-day period or so. The last 3 to 4 weeks of an option's life is when that steep, heavy time decay kicks in. And so many option traders think it's prudent to get out of the position before that rolls in. Okay, now I want to bring in the idea of volatility and show you how volatility impacts option prices. So imagine a stock. It's $50. It's a 3-month trip that it took from 20 to 50, and here it is. Okay, now consider another stock. It's also $50, and it rose the same amount, but it did it in a much quieter way. And then we can think of yet another stock that exhibits much more volatility. So this shows us a stock's historical volatility. But option prices have what's called an implied volatility to them. So one of the things you'll find is that options on a very quiet stock, like our low historically volatile stock A, it might be a very small percentage of the value of the stock. So maybe for this $50 stock, the right to buy it at $50 for 1 month might cost, just say, 50 cents a share or $50. The stock stock B, maybe it's a little high, 2%. And then a very volatile stock, you might pay much higher percentages of premium to be able to buy a call option on that stock. So this is where this relationship of historical and implied volatility comes in. So historical volatility, sometimes also called statistical volatility, is just a bounce in the stock itself. But an option price has embedded in it what's called implied volatility. And it's another number that can be calculated using some of those fancy math terms where things like delta and theta come from. Not super important to get into too much here, but if you are curious about it, you can learn more about it in some of those other webinars. So let me show you some real life examples of what I mean by this idea of implied volatility and how it impacts and how it's related to option prices. So I've got fake stocks here, but I think you get the idea. So the first one is a company that I'm calling Big Soda. The second one is called Chiptech, and the third one is Top EV Co. So these are actual stocks, and I just took data from them on a particular day. So Big Soda, the implied volatility of the options on that stock is rather modest at about 18%. Chiptech, certainly in the higher range at almost 60%, and then Top EV has very high implied volatility of over 85%. The stock price for Big Soda is $62.20. The stock price for Chiptech $63.44. The stock price for Top EV Co $109.82. And here are some option prices. I chose an at-the-money call as close as possible. They're not all, they're not precisely in the same relationship, but it still illustrates. So to buy a $62.50 call with 43 days to go on Big Soda, the call price is $1.76. That $1.76 divided by the stock price of $62.60 is 2.8% premium. Chiptech, stock $63.44, a 65 strike call was $4.45 for a 7% call premium. And the high implied volatility stock, the high volatility stock period, the option prices are a much more meaningful bite into the price of the stock. So this is how this idea of volatility manifests itself into option prices. So two sort of ways to think about this right here. One is differences in volatility between different kinds of stocks. But two is a recognition that the volatility in the stock can change. It can rise or fall, and that can, in fact, lead to changing option prices that you might not have anticipated simply thinking about a directional move. One of the little intricacies of option prices. So let's sort of summarize. What are these things that come together that make option prices move? Well, the first one is intrinsic value, a pizza coupon, right? And this is very directional. The price of options will rise and fall with the movement in the stock price. The more intrinsic value, the leads to higher option prices, all else equal, of course. And then there's time. Of course, the big aspect of time is it only goes in one direction. Intrinsic value can go up and down. Volatility can go up and down. Time waits for no one, and it goes only in one direction. And then we included the idea of volatility and its role in option prices. So that's the sort of foundational part, definitions and relationships. I want you to sort of pause for a moment and sort of let that sink in. You probably don't have it all perfectly, but going back and reading the deck, listening to this again, downloading the deck, I hope we're going to get you there. But let's talk about the steps leading up to buying an option, because that's going to be our topic of our second session today. So first off, I want to introduce the idea of liquidity. So liquidity, the definition of liquidity is simply the ability to move in and out of financial liquidity, to move in and out of an investment without moving price. So in an actively traded stock like S&P 500 Spider or Apple Computer, me buying 100 shares isn't even recognized by market makers. On the other hand, if I was a trading desk and decided that it was working for a mutual fund that wanted to buy 10 million shares of that, well, yes, my interest would no doubt move the market. And so liquidity is a comparison of how active the thing you're trading is and how big your order is. So how do we assess liquidity? So there's a few different markers we can look for. So the first is to look at the bid-ask spread and see how wide it is. This is not unreasonably wide. One thing you will recognize is the difference between the bids and offers in options is generally wider than it is for stocks. It's just the nature of the beast. So check the bid-ask spread. We're also going to look at trading volume. Volume is expressed in number of contracts. So in this case, that 50 strike price had traded 400 contracts by this time of the day. Pay attention to time of the day too. If you're looking at option volume right after it's open for trading, the volume's going to be light. So pay attention to volume. And then there's another column here that can be helpful in understanding the activity in that option. It's called open interest. So open interest, you can think of as the number of contracts that are outstanding. But here, let me explain to you how it works. Think of an option that has never traded before. It's its first day of trading. And I come in and I make the first trade. I buy 10 calls, and then trading closes. So the trading volume that day was 10 calls. I bought 10. Someone sold me those 10. And at the end of that day, the open interest is 10. 10 contracts that are outstanding. The next day, I sell 5 calls. And they are bought by someone other than the person who sold them to me. So he now has 5, and I have 5. The original writer is still short the 10, so the open interest remains 10. All that happened was 5 of mine transferred to someone else. If, on the other hand, I come in and buy another 10, and the market maker sells me another 10, or the trader that sells me another 10, then now the open interest is 20. So again, higher open interest, higher volume, tighter differences between the bids and the offers. These are the markers of liquidity. What you want to beware of are where these values aren't true. So here's just an example of very wide bid and ask spreads. I mean, take a look at any one of those. I'm looking at the 60 strike. It's 770 bid, offered at 1250. You could drive a truck through that, right? And if you look over at the open interest in the volume, it's essentially 0. So that's an example of things to pay attention to when you think about placing an order. The mechanics of the order are simple. I'll show you that right now, and then we'll talk a little bit about strategy before I pass you on to Sean and or, of course, introduce or welcome any Q&A that we might do. So to place an option order, and here I'm using the Power E-Trade platform. Later in the day, we're going to take a much deeper dive into both of our platforms, the website and Power E-Trade. But here on the Power E-Trade platform, which just as is the case with almost all of our platforms, the bids and the offers are generally links to create orders. So you can see here, if I wanted to buy this particular option, and I just clicked on that 47 right there, if I click on the ask, the logic of the platform is that I want to buy. So it brings up what we call the order ticket, where the details of the order are entered. So just like with a stock, when you buy 100 shares when you buy stock, you have to determine how many shares are you going to buy. Are you going to use a market order or a limit order? If you're going to use a limit order, do you want that order just for today or for a longer term? Those same elements are part of placing an option order. And so you work through that, and when you've are in agreement with what the ticket says, you get a preview, and once you send that, your order goes to the market. From that point on, and what leads up to why you would want to choose any particular one, I'm going to leave it to my good friend Sean Howell, who's going to be covering that in our second topic. But before we move on, I want to sort of leave you thinking strategically, first with a summary of buying options. What's good and what's not so good about buying options? Well, one of the pros is that you get leverage to the stock move. Talked about from the top of the day, right? Another really important one is that you have a very specifically defined risk here. What you pay for the option is the worst case outcome. And also, I would suggest that you have a very wide range of choice when you choose options as your trading vehicle. You can choose higher risk or lower risk trades. You can choose higher reward or lower or higher probability trades. All of these are things you can use to arrive at a strategy that makes sense for you. What are the cons? Well, the big one is time decay. When you buy an option, you're buying that time premium, and it is going to dissipate. Eventually, it's going to be zero. It's just a question of how much of it is there when you decide to trade out of the option. You have a limited holding period, and that, of course, can result in worthless expiration, which is the worst case. That's your defined risk. But there's so much more. You know, as I said at the very beginning, the intuitive understanding we have of how a call operation option is related to the value of a stock, it's a very easy relationship to see, I think. Things get turned upside down with puts, and things turn around a little bit when we start thinking about, well, what about the option seller? And then what happens when we start to combine option positions? So let me introduce something you'll see a lot of as you start learning more about options. And that's what's called a P&L chart. It's also sometimes called a hockey stick chart. So let me show you how it works. So if you buy a stock, imagine you bought it at the current price. The horizontal line here is the stock price. So further out to the right is the stock price rising. Over to the left until it reaches zero is the stock price falling. And so when you buy a stock, when the price rises, your profit rises. As you can see the way this is depicted here, that line could go on forever. So when you own a stock, in theory, you have an unlimited potential profit. There is no ceiling above there. And we know about practicality, but at any rate. On the other hand, if the stock declines, your loss begins to widen. And again, this is very sort of straightforward and understandable. The max loss occurs if the stock goes to zero, right? Now, let's think about what an option looks like. So here is how we would chart a long call, a call that we bought. Look at what we've got here. Notice our break-even point. It's higher than the strike price because we paid the cost of an option. So we have to get to a higher price. But then once we're in profitable price territory, we also have an unlimited potential gain, just like we did with buying a call option. On the other hand, what happens as the stock falls? Well, at any price below the strike price, we reach our maximum loss. And so we avoid the loss that occurred with the stock by it going all the way to zero. And so here is how a long call is depicted. By the way, we can also do Short stock, same relationship. One thing with that is that there's an unlimited loss potential. And then here's the way a P&L chart for a long put looks. Hence the hockey stick name. So this method of plotting where profit occurs and where loss occurs is a very handy way to start recognizing strategies. So let me just give you a taste of some of those strategies. There's our long call. Here's what a covered call looks like, our topic of session number 3 today. Here's what a bull call spread looks like. Kind of interesting. Almost looks like a combination of the first two, doesn't it? In some ways it sort of is. And then we can get a little more exotic when we start bringing in 3 and 4 different options to create positions like straddles or strangles or the famous iron condor. Just a tease here. You don't need to understand any of that. I want you to get used to the way this is charted. I want you to remember those basic terms and relationships, rights and obligations, buy and sell on either side, owning or writing. Those relationships are crucial, and it's what forms the foundation of all these strategies. Let me do a summary, and then I would like to ask you a poll question again. So look, as we kick off, this was a general introduction. We didn't even get to the point of making a trade. That's what Sean's going to be doing next. But I hope you can see that options do offer a wide range of benefits. You get leverage if you are seeking it, but you can also employ these in a number of other ways. You've got a lot more to learn, and I hope we have set you off on a productive path that way. So again, I'm going to tell my guys we can certainly do some Q&A if they are interested. But let me do my poll first. Okay, so how confident are you now, basically? I imagine many would be, I probably still need some additional sessions. Not quite. I'll review this on demand. Or I'm getting there. I learned something I can use. Maybe some of you are very confident and can't wait to talk to your friends about it. Well, whatever the responses might be, I certainly hope you got something out of it at least, and I hope you're sort of intrigued and piqued enough to continue on and eventually consume all of these. Remember, the one beauty of this is while we're presenting this live all day, they're available on demand afterwards. If you get weary of us by at some point in the day and want to knock off and come back, you can always do that through etrade.com/bootcamp, which is where we'll be holding these. All right, so let me ask Sean or Rick or anybody in the background. Guys want to do a little Q&A?
Dave, you just mentioned it, but the question has come up so much. Emphasize it again, if you will. The recording is available for all sessions and where they can find that. Because with as many people as we have on the call, that was probably number one question, and wouldn't hurt to really emphasize that.
Well, I'm flattered that so many people want to copy the presentation because that means it must be compelling content. So love that. So a couple things. So directly below the screen, the green widget, let me highlight it for you. I've got a little way to do that here. I'm highlighting the green widget. Actually, I think I can move it to the center right now too. At any rate, there's a copy of the deck in there along with some other links. As far as recording, yes, this is also recorded. That is available at etrade.com/bootcamp. And again, we record all of our webinars, and you can always find a whole bunch of other related topics at etrade.com/events. Our next one is scheduled for 12:30, so we have a little time. See, the number of questions are way, way high, but a lot of it are just commentary. Are there any particular topics, sub areas here that warrants a little more detail?
Yeah. Wow. My fingers are blistering. Okay. So you started down the path of Greeks, which is great. So a lot of the questions were, where do I find the Greeks on eTrade.com? And I know we're doing a demo later today, so that may need to wait. But if you want to verbally explain that, where do I find the Greeks on Power eTrade? That would be the other one. And then there's two other ones. How am I building some of these theoretical models for time decay? Like you created that table.
Yeah.
You want to talk a little bit about that? And then the other one is, I'm hitting you with all of them, Dave, is going to be, hey, that probability of being in the money, that's really cool. Where do I find that? On eTrade.com and on Power eTrade. So I hate telling everybody stand by, but do your best.
Yeah, no, that's cool. I mean, obviously, as Sean mentioned, virtually all of those things are what we will do specifically when we do our platform sessions later. But to give you a little verbal guidance, in the Power eTrade platform, all the Greeks are available as columns, and the way to control columns is in the platform in the upper right. And again, you can go to eTrade.com/events and just see a general overview of Power eTrade to learn the navigation of it. But there are columns for each of the Greeks. There are also many embedded other places where the Greeks show up in analyzing positions, et cetera. So you can have a column, for instance, for delta and theta in your positions listing in the Power eTrade platform. In the website, it's a little less. In the website, to get to the Greeks, you have to pull up a specific chain for the Greeks. So instead of looking at just calls and puts, it'll be a chain showing the Greeks for a particular options that you're looking at. I will show that. It is also from the option chain in the website that you can navigate to this theoretical value calculator that I used. And aside, I'm not sure how deep the knowledge of audience might be here, but the calculator that I'm talking about is using an option pricing model. And all I'm doing is inputting those elements to it. And it is something that I will briefly show later. The navigation to it is simple. When you're in the chain in the website, you'll see a link in the chain called Details. Click that, and that's where that input is. I saw a couple questions about levels. Yeah?
Yes, thank you. Yeah, where to get approval? Can I trade in my IRA? There was, questions about what about the taxation on these? And of course, I'm saying you can trade in your IRA, but try to hit those two little questions here too.
Okay, so a couple things. You do have to be approved for option trading, and the approval includes a level for your approval. There are 4: level 1, level 2, level 3, and level 4. Level 1 is the most restrictive. It only allows covered call writing. Level 4 is the most liberal. It allows you to do any and all option trades, including the most risky type of trades, uncovered options. In between are the 2 more common levels. Level 2 is the level needed to start to speculate, to be able to buy puts and calls and make those speculative type trades. And then level 3 is where you can begin to put together multi-leg option positions. So things like spreads, where you have you might own a put and a call, or sell a call and buy a call, a lot of different combinations. That's level 3. So level 1, 2, 3, and 4. Level 1, the most restricted and easiest to be approved for. Level 4, the hardest to be approved for. The approval comes about by you answering a number of questions about your personal financial situation, your investment experience, your risk tolerance, your goals with the account. All of those things roll into a suitability decision that's being made by people in our compliance areas that review your information and approve you according to certain relationships. There's no right answer. Don't ask me, what do I have to do to get this? What you have to do is answer those questions honestly. And tell us about yourself. So there was more about that question that I missed. If you want to check
IRA.
this. Oh, okay. Trading
in IRA. Yeah.
Yeah. So, and you also asked about taxes. Yes, option strategies are available in an IRA. Some are not. Selling covered calls certainly is. Buying calls and puts certainly is. Doing spreads is available. Selling uncovered calls isn't, for example. So, yes, available in IRAs. And then the question about taxes, I'm just going to say this. I'm not a tax professional. I'm not authorized to give tax advice or suggest that I have tax insight. I'll just say this. A gain you make in option is a taxable gain, just like anything else. So, there are a number of other curveballs in there, but I'll simply say go to irs.gov or consult your tax professional.
Okay, I'm going to give you kind of a big question here, and the question came up probably 10 minutes ago. We've had hundreds come in since then. We're doing our best. But the question is, why would I want to do this over stock? There's so much going on. And, one of my quick responses is, that's why we have an all-day boot camp. You may decide you don't want to do this, but if you are going to do it, there's a lot of things coming at you. So we want to be sure that you've got all that information. Dave, you want to dive any deeper into that? Why would I want to do this? It seems more complex. Isn't stock just easier?
Yeah, no doubt. I mean, look, it's kind of what I started with, right? The idea of using these instruments to make a trade is based upon two basic things. You get leverage, which short-term traders want, meaning if you think that the stock is going to make a 5% move, well, you might be able to make a 200% move if you pick the right option and trade in and out of it adroitly. So leverage is what attracts people. Hey, leverage is a two-edged sword. You're taking on more risk. So there's a question of your risk tolerance. Does that attract you or does that repulse you? Well, then you've sort of answered your own question about your risk tolerance. The moving parts, the complexity, is what gives you the flexibility to craft these strategies. And you're right. There's more work involved. There's more analysis involved. But it's all a matter of where you're lying on that spectrum of risk and return. You can buy mutual funds, and there you've sort of diversified out all the single stock risk, right? The risk that Elon Musk is a bad guy or that General Motors reports a bad number is lessened because you own, say, 500 stocks. You buy an individual stock, now you're subject to what's going on with that individual company, but you're just getting sort of a one-to-one relationship of the return, right? If you invest $1,000 and it goes up 10%, you make 100. Or you could use a margin account, which lets you borrow money to buy more shares than you have cash for, which means that you've increased the return that you get on the price move. So that's the first step in leverage, and that's generally just a 2-to-1 ratio. Options give us even more leverage. And again, whether that's attractive to you or not is a decision that you make. And by the way, remember, you can turn this around because you don't have to be the option buyer. You could decide, wait, I own stocks. I can sell some of these calls to these gamblers out there and take in some of their money for it. And guess what? That's the topic of covered calls coming up in session number 3. So,
hey, I'm going to hit you with one more.
So many questions, I'm not sure if I answered them all.
There's no way. I mean, we built a whole day, but hopefully I'm seeing a lot of questions that I know will be answered. But I want to hit one that's kind of just fundamental to this whole conversation. It's from Ramanal. You buy a call. Should you sell your call before expiration to receive the profit if the stock price is higher than the strike price? So, Dave, this question kind of goes back to the tradability of it, that time factor.
Yeah.
And you and I have been doing this long enough that we hear, hey, I saw a statistic that said that 90% of options reach expiration unexercised. Does that mean that 90% of people that are buying them are losing money? You want to tie those two together, and maybe that'll bring us in for the landing, give everybody a break, quick coffee break, and then I'll be back. But you want to hit that one?
Yeah, so the other part of the stat that Sean is talking about there is that the vast majority of options are closed out prior to expiration. And we alluded to that a few times here. Remember what I said when we were looking at that time value chart showing the decay? One of the points I made was that many option buyers, their strategy is to use the option temporarily to ride a movement in the stock and to get out of the option before that last, say, 20 or 30 days kicks in, where the time decay becomes really harsh. So one of the sort of ways to apply that is, say, maybe in your chart analysis, you believe you have a target price for a stock and you think it might take 30 days to get there. Well, some people might say, oh, so I should buy an option with 30 days to go to expiration. And we say, no, you should probably buy an option that has 60 days to go to expiration, or maybe 75. That allows you to hold that for 30 days. If it reaches your price target, trade out of it before the onerous time decay comes in. So that's the idea. That's something that Sean is going to develop meaningfully in our next session. Confident of that. Hey, thanks a bunch for coming. We had an enormous turnout. We're so happy and proud that you've turned up. It's great to see people want.
But we're not done. I was going to say we're not done. I'm up next. Dave, real quick on the surveys, and then I've got like 10 questions in here about, is there a way I could practice paper trading? So, and then then we'll bring this to landing. But yes and yes on that.
You bet. Again, this survey is the teal colored widget. I'm highlighting it right now. It'll also be in a separate window when we shut this down. It's very brief. It really is very brief. Just ask you to give it a value 1 to 5. And if you have any comments, and I can promise you this, we read the comments, all of them. And I'm sure some of you know those comments do impact the content we create. We use it actively. So we would appreciate that. And then what was the last question? Oh, paper trading. Yeah, so on the Power E-Trade platform, paper trading is in the launch pad right below it. And it's a clone of Power E-Trade. And yes, it lets you practice trades, put option trades on, et cetera. Something I'll at least show navigation to it when I get into the website. And maybe Sean will touch on it a little bit as well. All right, so let me go back to my close. Thanks a bunch. Appreciate it very much. Let us know how we did. Tell your friends all about this. Watch it again if you wish. Download the survey, the presentation. And again, I can't thank you enough. We'll see you in the next session in 18 minutes. Take care.